the type of companies we invest in that we think can have a big impact on society if they get to scale, believing in people before other people are believing in them, potentially with capital being the first check in and like helping them to, in turn, to create a bunch of jobs.
You're listening to the Real Returns podcast, where we learn how real investments can make a real impact. Join your hosts, Andrew and Dan, as they share stories and interview business leaders on how real estate and other forms of investment can create meaningful change for individuals and communities around the world.
Hello, and welcome back to another episode of the Real Returns podcast. I'm your host, Andrew Reichert. I've got my co-host, Dan Croce. Dan, what is happening with you today?
Well, if you know anything about me, you know I kind of like college basketball, and March Madness tips off this week. And look, I decked out for the occasion. Duquesne, our local little tiny Duquesne University here, made the tournament this year out of the Atlantic 10, first time since 1977. So it's an exciting time in Pittsburgh.
Thanks.
But that's not the point of our show today. I am really excited to have Michael Cardamone here. He is in the venture capital and early stage investing space. So it's not something we typically learn about here on the show. So I'm excited for that. But Andrew, actually, before we jump in, I did have an investing question for you.
Yeah.
So here it is. What do you think in today's market is the best way to make a small fortune?
A small fortune.
I can just tell you the answer of my opinion if you want. So
Yeah.
it's investing a very, very large fortune in venture capital. And then you'll turn it into a small one.
Ouch.
Just kidding. No, so actually, prior to real estate, I had a background in early stage investing, and it sometimes gets a bad rap with real estate people who tend to be sort of, focused bricks and mortar, low risk appetite type folks. So I'm excited to have Mike here on the show, who is the CEO and managing partner of Forum Ventures. They invest in over 100 B2B software businesses per year. So Mike, thanks so much for being here and for being willing to educate us a little bit and tell us about what you do. Can you introduce yourself?
Yeah, how's it going? Before I introduce myself, I think that's probably true. If you were a big fund investing mostly in 2020 and 2021, you certainly likely turned a large fortune into a small fortune in venture. Anyway, Mike Cardamone here, CEO, managing partner of Forum Ventures. We are an early stage kind of platform with three different strategies. We have a traditional kind of early stage pre-seed seed fund. We have an accelerator, which I can talk more about. There's a show where we've been running for 10 years. We're on our fifth accelerator fund, where we're like first check into a high volume of companies. And then we have a venture studio where we have a team of 11 people starting tech companies from scratch and then bringing CEOs in to run those companies. So three different strategies. We're 31 people full-time across the company, based out of New York and Toronto mostly.
Yeah, that's fascinating. And Mike, one of the things we love to talk about here is just impact. And I've got to think, as you're investing in these small businesses, often before others are believing in these businesses, I've got to think you're not just having an impact on these businesses, but really on our economy at large. How do you think about that in the business that you're in?
Yeah. So we think about impact a few different ways. I think one is like, how can we have an impact on an individual person? So like, how can we help them maybe build something at more scale or faster or better than they otherwise would have been able to do? And then, once you do that, then it's like, okay, now what impact is their product or business having on society? And also, can you help, if you help them grow, like, can you help them then create a lot of jobs? And so that's another piece of it. And then we think because we're investing so early, we can also have an impact on helping to drive more kind of diversity and inclusion within the startup world, which traditionally has many industries, been well below where it should be. But we think like if we're the first check in, it's a founding team. And then if we can create like programming and information around the benefits of having a diverse team from the beginning, we think like if the first 10 hires are diverse, you're going to end up with a much more diverse company at scale. So I think we think about impact a few different ways. But yeah, we think we're kind of in a unique position to have an outsized impact from all three perspectives, and like the type of companies we invest in that we think can have a big impact on society if they get to scale, believing in people before other people are believing in them, potentially with capital being the first check in and like helping them to, in turn, to create a bunch of jobs. So yeah, we try to have an impact in a bunch of different ways.
Yeah, I love that. And I love how you're thinking broadly, sort of multi-pronged approach to impact. I'd like to dig into one of those approaches, the diversity and inclusion piece. As with most industries, there tends to lack diversity, particularly at the top, particularly founders of companies, some of the folks you work with. So what does it look like for you to be intentional in that space?
Yeah, I mean, first and foremost, we need to have a diverse team ourselves in order to like really look at this through the right lens. So part of it is like as we were building our team, we were very intentional about having a pretty diverse team across our 31 people. And then the other piece of it is like, we are a very data driven firm, and we look a lot at all parts of the funnel of like inbound and like companies we're talking to through the pipeline that we end up ultimately investing in. And so the only way to improve on something is to track it. And so when we track all of that, we look at, that's one of the kind of KPIs we look at is like throughout the whole funnel, how are we doing as far as like talking to and investing in diverse founders, and then making sure that we're making a concerted effort to find more diverse founders through the pipeline, and making sure that we're, they're kind of moving through the pipeline as would any other founder moves through. So one of the lenses we look at closely, and we're constantly trying to improve that, and certainly could be doing better, but I think we're well above where the industry is today, which is a low bar, sadly.
Yeah. Well, often even just thinking about it and being intentional about it, raises awareness and
Yeah.
starts to drive change. So I appreciate that you're doing that. Digging into one of the other prongs, the businesses that you're investing in, what are some of the changes that those are having, some of the impact that those are having in the world?
Yeah, so we invest across a number of different categories. One of which is healthcare. We do a lot in supply chain logistics. And then a lot of vertical SaaS and software companies selling into like niche industries. And so when we look at some of our companies, it's just creating like better workflows and more efficiency for people at work, which is like less interesting from an impact standpoint, but still can build really good businesses that way. But when you look at some of the like the healthcare companies and even some of the like gov tech companies we've invested in, they can have like real impact at scale on people. So you look at, we have investing companies like Remo Health, where they're building a platform to help like caregivers caring for people with Alzheimer's, a lot of resources and a platform to help manage that care, help provide data back to health systems to provide better care. And so like really helping on that front. People like companies like Blooming Health, where they're helping people kind of stay at home as they're aging and get access to resources a lot easier. So we invest in a lot of like AI around diagnosing, doing better, more accurate diagnosis for like cancer, breast cancer, other types of cancer. So we do a lot of stuff in healthcare that I think at scale could have like really meaningful impact on people's lives and how our health systems operate. And so something that, I spend a lot of time there. My wife went back to school for nursing like 4 years ago. And so I've been like really leaning into healthcare and healthcare investing as just an area where I think one is like a great area to be investing in, because I think our healthcare is like pretty broken, and there's a lot of opportunity, but also I think if you do it well, it can have a big impact on a lot of people, obviously. So that's one of the areas that we think about. We do a lot of stuff around like climate tech and clean energy. We do a lot in like supply chain logistics, but some of that is like decarbonizing buildings and 3PLs, like trying to, create more efficiencies around like what's being moved around and from where. And so a lot of the companies we invest in have an impact on society, but healthcare is probably the most obvious area.
Yeah, no, it makes a ton of sense. And I'm curious, Mike, for folks who may not be as familiar with venture capital, what does it look like to underwrite those businesses? What is your process for saying this is a good investment for us?
So we have, like I said, we have 3 different strategies, and everything's a little bit different. I'll take, so one is a venture studio where we're starting companies from scratch. In that we come up with ideas. We look at like macro trends of like where we think there might be opportunities. And we come up with ideas that we think could be interesting in those areas. And then we go talk to as many customers as we can. And so a lot of out of the studio, when we decide to start a company and then therefore put capital in and like really get it going and bring in a CEO, it's, can we find someone who has like really good founder market fit, where they deeply understand the market we're trying to invest in? they have connections and experiences that give them some unfair advantage in that market. And then are we seeing like really good customer pull and interest from companies? So that may be talking to a bunch of customers, lining up design partners, like clearly having a lot of interest. Like we did one where it's, leveraging AI to kind of find, apply for, write grant applications, and then manage all the compliance around that for climate grants, which is, there were a lot of grants being, available that are tedious to find, tedious to apply for. Then there's like a lot of, onerous kind of compliance and financial stuff around it. And so we started a company in and around there because when we talked to climate tech companies that were trying to find these grants and access these grants, it was like a no-brainer for them. And there was like really strong pull. And then we found a founder and CEO who has been in climate tech for like 15 years and understands the space, has felt the pain point. So like that's an example on the studio. On the accelerator is a really high volume. So we invested in 84 companies last year through the accelerator. We'll do a similar volume this year. And that's usually a founding team, some early version of a product. And we're the first check-in, usually with 100K. And on those, it's similar. Like they're usually pre-revenue or very early in revenue. So a lot of the bet is on the founder market fit, and then market and market dynamics of like, do we think what they're building is inevitable? And then do we think this is the team to help kind of navigate through that evolving market that we feel like if all the chips fall in the right way, like it will be a big company. And can be kind of venture scale, which we think about as like hundreds of millions in revenue potential, if not more. So that's what we do on the accelerator side. And then we have a traditional seed fund that invests at a slightly later stage. Usually there's some customers. And so a big part of that, aside from founder and market, is like talking to the customers and understanding why did they buy it? How important is it? Would they pay more for it? All that kind of stuff. So that's at a high level. Those are some of the things we're looking for.
Yeah, makes sense.
Michael, one of the things that I find really fascinating about your model, especially from an impact standpoint, is just how early you are thinking about that venture studio where these are things that you're ideating. So you really are the entrepreneurs in that instance. You're coming up with the whole kind of concept. And so I think both in terms of, you sort of envisioning what's needed in our world and how can we create that. And then also just in terms of, creating outsized returns. I'm sure when you create those companies, you've created them, so you own them on day one. So you talk to us a little bit about, and then similarly for the accelerator program, I think there's probably some crossover characteristics there, but because you're so early, you have a really high leverage ability to impact the future of those businesses. So is that why did you land in, such an early stage piece, and tell us about the impact you can have?
Yeah. So why the early stages? My background is I moved out to San Francisco. I'm from upstate New York, but moved out to San Francisco and ended up at a company called Box when it was about 25 people. They're now a public company, but I was able to get a lot of operating experience there and at another company. And so the accelerator model is such where you're like very hands-on. You're almost like an extension of the founding team. And so when I first started this, it was an opportunity for me to scratch the itch of like wanting to invest in these companies because I had been doing some angel investing and had a couple that were like off to a really good start. I probably thought I knew what I was doing when I had no idea what I was doing because of those angel investments that were off to a good start. And so it allowed me to both invest, but also be like really involved operationally and like scratch that itch as well. So that was why I decided to go really early. And then once we started building the accelerator and it was working, we kind of felt like, okay, we've built the like infrastructure and rails and platform where we're investing in a high volume of companies, and we've helped companies go from 0 to 1. Now I want to build a fund that can like put more capital into the ones that are working, and then also go do the -1 to 0 part to like keep scratching that like entrepreneurial operator itch of actually starting companies. And yeah, because we're so involved, like we could have a really big impact on helping them get those early customers, thinking about like what's the right narrative and vision to be able to raise capital downstream from other investors and help them with that process, build network to do that. So we can have a big impact. And then I think from from our LP standpoint, we think getting in really early allows us to get a relatively high amount of ownership versus the check we're writing through the accelerator model, especially. And then through the studio, we get even more ownership. And if you look at those products separately from like an LP's perspective, they're pretty different products with different risk rewards, even though like early stage venture as an asset class is like a risky asset class. Obviously, we think there are two models that make the math a lot better for LPs, and they're very different. An accelerator is highly diversified, very low average entry price. We've got 10 years of track record on those funds now, and they perform really well, but it's like a pretty predictable band of where they're going to perform. Whereas the studio is like concentrated portfolio, like we'll start maybe 15 companies out of the studio fund, but we'll own a ton of each one. And so like the variability of outcomes is high on that one, right? Like it could be, a 20x fund if you hit a big one, or even higher, or it could be, a dud if you don't. So like the variability on that, it's just like a higher risk, higher reward type of product versus the accelerator, which is very diversified, like to the point where we think we've almost like diversified out the risk of that because the entry prices are so low and it's so diversified. And then you have like traditional early stage venture, which there's a lot of data on performance around that. I think smaller funds tend to outperform bigger funds. And so we keep our funds pretty small, but yeah, some funds do really well, some funds don't. So it's just as in any asset class, but
yeah. What's a typical size of a fund for you guys?
So we have a little over 100 million in AUM across the funds. The accelerator funds have scaled over time. The seed funds the first one was like 13 million. The next one's 17 million. We're going to target quite a decent amount bigger for the next one, but not too big relative to the venture ecosystem. But that's the funds on our side.
Yeah. So I'm curious, Mike, what advice would you have for two sets of audiences? The first is somebody that's interested in maybe getting into venture capital. You told a little bit about your story with Box, but obviously venture capital is a sexy space. Maybe somebody wants to get involved in investing in that way. And then second, founders who are interested in raising venture capital. So what advice would you have for those two groups?
Yeah, the first one, I think it's just really understanding what unique advantage or differentiation you have. There was an explosion of funds throughout 2020 and 2021 when capital was a lot easier to come by. And a lot of those funds are not going to be able to raise their next fund. There's a lot of like fatigue from LPs who felt burned from that era where they, were throwing too much capital into a space where it was just like on fire, prices were too high, valuations were too high. And so I think like right now to raise capital as a first time fund manager of someone who's trying to break in, it's really hard unless you have some clear kind of differentiation, or you have a long track record as an angel investor, or access to some unique and differentiated, network that others don't have access to. Like you need some sort of edge, I think, to raise capital in this market, when it's probably harder to raise a venture capital fund than it's been in the 10 years I've been doing this. So not to discourage people, like I had a lot of people tell me I shouldn't raise a fund when I did, because I had no business raising a fund when I did. I had no track record, and was able to like through it, and it's ended up kind of working. But so definitely don't want to discourage people, but just understanding that it's like a really hard market to like break into as a net new person trying to break into venture with a new fund. On the startup side, I think you were just asking around like how should startups think about raising venture?
Let's say I'm a founding entrepreneur and I'm looking for my first check.
Yeah. So I think part of it again goes back to, why are you the right founder to be building what you're building? So in this area, like I think a lot of your audiences in the real estate space, like if you've spent a lot of time in the real estate space and you have some unique insight around like some new way to manage properties or leverage AI to like predict kind of, where you should be buying your next property, or, something related to what you've been doing in your industry for a long time and have connections in that industry, then I think like that's the sort of stuff that you need to have in order to raise capital, is that like unique founder market fit where like you're the right person or team to be building what you're building and have some unique insight, some unique distribution advantage through your network or something like that. And then go out and tell that story in a compelling way with a big vision. So yeah, I think that's kind of how founders should approach it.
Yeah. Makes sense.
Maya, that's actually something I really miss about being in the VC space is there's so much people evaluation, so much, really trying to dig in and get to know founders and understand their DNA, their vision, their work ethic, their, all of the things that you're talking about in terms of evaluating. But it definitely leads to great returns if you can identify that right problem founder fit.
Yeah. And I think because of the volume of companies we invest in, we invest in over 100 companies across the 3 strategies a year, and we've invested in 450 companies now to date. I feel like we have a lot of data points to learn from relative to most traditional VCs who invest in like 5 to 10 companies a year, which I think has been helpful.
So along those lines, Mike, could you tell us a time where it didn't work out, and why didn't it work out? You don't have to give us a specific name or company, but when it goes wrong, why does it go wrong?
Yeah, there are a lot of reasons things don't work out. When we're investing as early as we're investing, certainly a lot of them don't work out. So I would say the most common ones are people issues. So founders not getting along for some reason, they break up or they disagree on something or whatever. And that can often blow up a company, because if the founder owns a bunch of the company and then they leave, and then there's bad signaling around that, they own too much on the cap table, and it's hard. It creates a lot of drag on the company when that kind of stuff happens. And that stuff happens, right? People are not going to get along. That's hard to predict sometimes. Then there's the more business related things, if you're selling into big enterprises and you're an early stage company, sometimes you have a tendency to put all your eggs in 1 or 2 baskets, because you're if I just close this one customer, that's gonna be a $500K contract, I'm golden and I'll go raise, and you'll spend a lot of time on it. And those always take longer than you think they're going to take. And there's politics involved, and your decision maker might have left, and all the different reasons why that might not happen. And then it doesn't happen. And now you're out of money because you thought it was going to happen and you were waiting for that to happen to raise money. And you kind of put too many eggs in that basket. So we see that happen sometimes. But yeah, there's a lot of reasons, but those are maybe 2 of the more common ones.
Yeah, makes sense. I mean, I can say after a decade of being in partnership with Andrew, I'm just glad we've never disagreed about anything.
That's right.
Yeah.
Dan's like my work wife, as I would say.
Yeah.
Hey, Mike, really appreciate the education you've given us today and the insight. I admire your firm, and I do think you guys are doing things that are probably going to generate some attractive risk-adjusted returns. So
I hope so. We've got to we got to live up to it after the joke in the beginning. So,
well, hey, I'm going to transition us to hopefully get to know you a little bit more on the personal side. So,
sure.
What would you say throughout your lifetime has been your biggest win?
Well, on the personal side, it's having 4 kids, and while building this, that are, knock on wood, happy and healthy, and just exhausting but awesome. So that's on the personal side. That's definitely my biggest win.
That's awesome. What are the age ranges?
They are 8, 7, 4, and 2.
Whew.
Yeah.
So you're in the middle of it.
Yes, we're in it.
And Andrew and I are right there with you.
Yeah.
What's your favorite movie?
Yeah, not to overemphasize on the kids stuff, but I feel all I do is watch Disney movies now. So it's hard to think back to movies pre that. So my favorite Disney movie right now is Luca, and my kids are sick of me asking them to watch Luca whenever it's movie night, because they're we're
great
watching Luca anymore.
Yeah, that's funny. Yeah, me too. I'm I can't get enough of Leo on Netflix.
Yeah, Leo's great too. My kids, my 7-year-old is big into hockey, and I just had him watch Mighty Ducks for the first time, and he was now just can't get enough of Mighty Ducks. Loves it. Classic movie.
How about your favorite food?
That's a good one. I love food in general. I'm Italian though, and so probably my mom's homemade ravioli or lasagna or something like that, I would say. But yeah, I love all food.
That's a good one. That's actually someone's homemade lasagna is a very popular choice for that question.
Yeah.
And I get it. It's tough to beat that. What's a current growth edge for you these days, either personally or professionally? What's a way in which you're trying to improve and get better?
I think health is one where I've never really spent a lot of time paying attention to my health I think I've always had like a good metabolism. And so like I eat a lot and don't gain weight and stuff. But I think as I've gotten older and with kids and busier with work and stuff, like it, you start to realize like you really should pay more attention to health and nutrition. And so I've been spending a lot more time on that, which I think will also make me more productive at work, frankly. But yeah, so that's probably one area that I'm personally kind of focused on right now.
That is a wise thing to pay attention to.
Yeah.
Good for you there. Well, awesome, Michael. How can our listeners learn more about you or get connected to you?
Yeah, we're just at forumvc.com. I'm Mike at forumvc.com. I'm on Twitter and LinkedIn. But yeah, happy to chat if folks are interested in the venture space or starting an interesting company.
Yeah. Well, I'll tell you what, I'm definitely inspired just hearing a little bit of what it looks like to be in the venture capital space. I mean, I love how you think of impact for the founders, the impact you're having on their lives, impact that those companies are having. And specifically in the healthcare space, it's, as you mentioned, a broken industry, and every single one of those startups has an opportunity to totally disrupt and transform that industry.
Yeah.
And I love what you're doing on the diversity and inclusion side as well. I think that's an area, obviously that hasn't got enough attention historically, and something that is finally getting some awareness, and you guys are actually doing something about it. So Mike, thanks so much for being on the show. Learned a ton from you, and yeah, thanks for joining.
Yeah. Appreciate you having me on. Thank you.
Thanks, Mike.
Thanks.
Thank you for joining us for this episode of the Real Returns podcast. We hope that you learned something new about how you can invest to make a lasting impact on those around you. Please be sure to subscribe to our show wherever you listen to your podcasts, leave us a review, and share about us on social media. We hope you will join us for our next episode, where we will be continuing the conversation around impactful real estate investing.